Hi, everybody. Welcome back to Dividend Stockpile, where we talk about all things dividend and income investing related. Today, we have a very special guest, John Bartlett, the president of Reaves Asset Management and portfolio manager of the closed-end fund we're going to be discussing today, is UTG, the Reaves Utility Income Fund. So John joined Reaves Asset Management in 1995. He was named the president of the firm in July 2019, and he also co-manages the Virtus Reaves Utilities ETF. John received his bachelor's at Connecticut College and is a CFA charter holder. John, welcome. How are you doing today?
Well, I'm doing really well. Thank you very much for having me, Jeremy.
Absolutely. UTG is one of my absolute favorite funds. I've held it for a long time. So when we got the opportunity to connect, I was very excited to have you on. So we look forward to our conversation today. And I know the audience will really love this fund. It's been one of my best performers. So I'm happy to talk through this. So before we really get into the details, can you give us a little bit about your background as well as the company's background?
Sure, of course. So we were founded in 1961 by Bill Reaves, and we really started out life as a utility-focused research firm. We started managing money in 1977, and as you said, we managed the Reaves Utility Income Fund. The ticker symbol for that is UTG. Done it for over 20 years. It's a income-producing closed-end fund, and we also have the Virtus Reaves Utilities ETF, and that's really focused singularly on UTG, is a bit more diversified. And we also have separately managed accounts. I've now been with the firm for 30 years. This is my life's work, and our mission really is to provide solid risk-adjusted returns across really conservative stocks. That's really what we're all about.
Yeah, and we'll talk about the performance later, but not to bury the lead. I mean, since inception, you guys have beat the S&P 500. So to do that with a utility-based strategy is incredible, and I can't wait to talk more about that. So a lot of investors aren't really familiar with closed-end funds. Can you give a 30,000-foot view of what a closed-end fund and how it differs from a traditional ETF, just for everyone's awareness?
Oh, absolutely. Yeah. So a closed-end fund is an investment company that trades on a stock exchange, just like a regular stock. Unlike a open-end fund or an ETF, shareholders need to sell their shares to somebody else rather than have some kind of a redemption event. Mm-hmm. And so for us and the way we manage UTG, the big advantage that we get is that we get to manage UTG like an operating company. We manage the fund to provide large monthly distributions to shareholders, and we use a managed distribution to create a consistent and visible distribution to shareholders. That's really what it's all about. You know, when you have a static portfolio the way that you get in a closed-end fund, you really get the opportunity to do things without big fund flows that are going on. And at the same time, we also can use leverage to increase the distribution. So that's really what the whole closed-end fund structure is really all about.
Yeah. So when it comes to closed-end funds, I'm a huge fan, and I love the fact that you don't have to worry about paying out shareholders who decide to sell their shares. All the shares are traded on the secondary market, so you can focus on investing in the quality companies. But in the long-term mindset, you don't have to worry about cashing out a certain portion of your investments because someone decided they wanted to sell their shares of the closed-end fund. And so typically speaking, you can see more variety of investments you guys can cover, as well as, you can look at things for a long-term investment as opposed to short-term thinking. So I've always really enjoyed closed-end funds for that side of it, things.
Yeah, and as I say, the whole concept of running an investment portfolio like an operating company is very significant to us. It allows us to do financial planning, budgeting, and things like that. So, really, when we manage the fund, we really gear it towards generating more income.
Yeah. And the income is quite substantial. We'll talk about it later, but you've been very consistent in your income approach. You've even raised the distribution over time. And so the strategy that you guys are using has definitely worked so far. So can you kind of give an overview of the utility sector and maybe some catalysts that are coming in that world in the next 5 or 10 years?
Sure. Let me just sort of begin again, to just say that the UTG is a fairly diversified portfolio, and really what we're trying to do here is generate income. And to your question before, we've raised the distribution 12 times since inception, and we've never returned shareholder capital. And for maybe some of your viewers who aren't really that familiar with the closed-end fund structure, what that means is we've actually earned the distribution through dividends and capital gains in the portfolio, rather than sending shareholders back their money and just calling it yield.
Mm-hmm.
That's really important. So, getting back to your next question, the fund focuses on utilities and utility-like investments that have limited competition and high barriers to entry. That's the basic theme of what we do.
Mm-hmm.
We look for stable businesses that are capital intensive, that have very defensible franchises, and in fact, many are, of course, monopolies. Utilities traditionally are, and have outlooks for steady but not outsized growth. So when we talk about growth, we're often looking at 5 to 7 versus 6 to 8 versus 7 to 9, and those are that's sort of the spectrum of what we're looking for. And from our perspective, when we look at percentage annual growth of earnings, even the right side of the decimal point matters to us. So
Mm-hmm.
it gives you a sense of what we're hunting for.
Yeah. So to your point about being diversified, looking at as of 3/31, you're about 60% utilities.
Mm-hmm.
Then you have communication services, industrials, energy, real estate, materials. So you do have some exposure to other sectors, but utilities does make up the majority of your portfolio, at least as of that time. And I'm sure that's usually the case.
Yeah, that's absolutely right. I mean, 80%, and we use a very a fairly broad definition of you have to be 80% in utilities.
Mm-hmm.
And utilities are also defined as not just the regulated electric and gas utilities, but also companies involved in the communication space, companies that are involved in things sort of all fit the bill for us. So that's part of what we do.
Yeah, and I see that you also have some midstream energy holdings in the fund as well. So it's quite diverse. But I think again it goes back to your point of very defensible companies with big moats, usually monopolies in a certain area, and they're involved in the energy production, but they also provide cash flow. So those are all kind of things you can look at. So looking at your top 10 holdings, it looks like Talon Energy,
Mhm.
Deutsche Telecom, Entergy, Vistra, and iSource,
Mhm.
among some others. So obviously those are all very wide moat type of companies and industries. So it totally makes sense what you were saying. The question is, since you are very heavy in utilities right now, but also some other sectors, what are some of the drivers of the growth in this industry going forward?
Yeah, so I mean, it's a pretty exciting time for utilities. As I say, I've been doing this for a very long time,
Mm-hmm.
and this is about as exciting as it's gotten for me. That said, there's plenty of different opportunities for varying levels of risk, and we try to keep a pretty good balance there. Really, the elephant in the room, to use the cliche, is power demand.
Mm-hmm.
And power demand in this country really grew a lot in the post-war period into the 50s, 60s, and 70s on the back of industrialization and air conditioning. And then when you look to the 90s and the early part of the century, it had pretty much stagnated.
Mm-hmm.
At the beginning of my career, growth in electricity demand was GDP plus 1, maybe even GDP plus 2. And it slowed to GDP plus 50 basis points to GDP to probably 0.
Mm-hmm.
And reshoring and artificial intelligence has changed all of that and put it on its ear literally in the last year and a half. And so the whole space has had to adjust to that. For the regulated utilities, what this does is it probably adds 100 to 200 basis points of earnings growth. Maybe a little bit more than that. But what it does do is that it gives them a very long runway of growth. And so, I talked earlier about having, a real focus on 100, 200 basis points of growth. And what that means to shareholders is that if you've got 7% earnings growth, and a lot of these companies are going to be able to do that with the backdrop of having to invest in their companies, plus a 3% dividend yield, all else being equal, you can expect a 10% total shareholder return over the course of a long period of time. Obviously, there'll be some volatility,
Mm-hmm.
but if you can do that and you can put it into a stock that's got a beta of 0.3 or 0.4, something with considerably low volatility, the risk reward is excellent. That's sort of the baseline for what we do in terms of risk, and everything sort of gets benchmarked off of that. At the higher level of risk would be, the independent power producers, and we think that they're exceptionally well positioned because, we just simply don't have enough power.
Mm-hmm.
I could go through the whole history of it, but we built a lot of generation in the early 2000s just in time for electricity demand to stagnate. We burned through that. And as I said, we've gone through the last couple of years with a real reckoning of how much power we're going to need. In a ability to serve that power isn't going to be coming online really until the late part of this decade, early next. And so the incumbents are in a great position right now, and we think we've been pretty early to the game on that one, and we still think that things are looking pretty good there. So again, you have to sort of understand the arcane world of regulated utilities. Utilities are regulated. Idea here is that they are only supposed to recover their costs. And one of those costs is the cost of capital, interest, and earnings. And as a consequence of that, when more money gets spent within the company, earnings go up. And that's how a utility grows. It's really backwards relative to every other industrial company that you might look at. Whereas, a company will decide to build plant and equipment because its sales growth is growing, and the profitability will come from the bottom down. In a utility, it's totally different. The utility is called upon to serve a load, and it puts more money into the system, and therefore it's regulated on what it has invested in the system, and it's built from the bottom up. So they're strange companies, and I've often argued that they ought to be considered their own asset class as a consequence of that. MLPs and things like that got that moniker. I haven't been quite so successful. It's still kind of considered a sector, but at any rate, it's a special one.
Nice. And just going back to your, you should expect maybe 10% a year. I mean, if you look back at your fund's long-term average since 2004, I'm showing at just over 10% total return since that time. And so you're talking about over 20 years of averaging 10%. Talk about consistency, and you can, if you're using the income, you can rely on that distribution every single month to pay your bills. But if you're just reinvesting it like I am right now in my accounts, that just compounds on itself over time. And to your point, a lower beta, so it's a little bit smoother ride than, SP 500 or QQQ or something like that. So it's been a very, very good investment. And it makes sense that they would have that type of returns because they are regulated. There's an expected certain amount of profitability that they're setting up when they set up a new plant, and they also have the ability to raise it with inflation plus, as time goes on. So it's a great defensive business to be in. So I really enjoy the utility sector, and it's kind of funny that you said it's so exciting right now. It's probably not many times in the world that we could say that utilities are exciting, but with AI generation and all the excess power needs that we have with everything being connected to the internet and things like that, the demand for power is just to continue to grow over time. So I totally mirror your expectation of it being an exciting time. It's just funny to think about it that way.
Yeah, well, I get pretty energized by this stuff. Probably, that's what's kept me interested in this, and I find the industry to be fascinating. And part of it, and I would just offer folks a couple of caveats. The trajectory isn't always perfect. Electric and gas are very political commodities, and regulation definitely swings for good or bad. But I will tell you that worrying about that is our job, and that's really why we come to work every day. And I would also tell people that one of the reasons that we have gotten a 10% return as opposed to a high single digits return is we do use a little leverage, but the leverage itself has magnified the returns a little bit. It's also magnified the income even more, and so that's an important part of it as well.
That makes sense. And for those who aren't aware, closed-end funds do have the ability to use leverage to add the assets to the portfolio that they can use to invest, and so that, to your point, can magnify the returns. It can also magnify the losses, but at least in your history, it seems like it's helping more than it's hurting.
It
Do you
has,
have a
and I think it's important to take a second. Is one of the kind of key fundamentals for us as managers using leverage is we do use less leverage than most of our peers. A lot of leverage, a lot of our peers. You can go up to about 33% leverage, and then you can issue preferreds and things like that to go even higher still. If you kind of looked at our history over the last couple of years, we've kind of kept it between 20 and 25%, which is a place we're very comfortable with. One of the things that we can go into a little bit is sort of the interest rate environment. We do fund with short-term money, and we find that generally speaking, having a little less leverage is really one of our best protections against rising and falling interest rates.
Yeah, that certainly makes sense. There's not been many times in recent memory that the interest rates have been as high as they are today. But I think with the policies that are coming up in place, interest rates will more likely be steady or going down over time.
Mm-hmm.
I think a lot of people would struggle if we continue these high rates for too long. So hopefully that's a net benefit to utilities going forward because it's not going to cost as much.
Yeah, it should be, and we don't consider ourselves to be experts on where interest rates are going. We really aspire to be utility experts, and we kind of by and large do what interest rates tell us to do.
Yeah, and that certainly makes sense. Before we dig into the specifics on this fund, go through all the data, I had one other question for you.
Sure.
So renewable energy has definitely been one of the hotter types of energy production over the last couple of years. The cost of solar, cost of wind is all coming down. So in a lot of places in the world, it's the most economical approach to power generation.
Right.
But then there are some negatives as well. It's like obviously the sun's not always shining, the wind's not always blowing. You may not be able to produce the energy where you need it. But overall, renewable energy has definitely been increasing pretty quickly over the last couple of years. What is your guys' view on that, or do you guys have any kind of focus on that side of the business as well?
Absolutely. Look, I think as I kind of mentioned earlier, we're going to need everything that we can get, and there's many different types of generation out there. They all serve a specific purpose. And right now, renewables are cheaper than anything that you can buy elsewhere. That said, they're not just cheaper; you can actually get it. Combined cycle gas turbines, it's going to. If you wanted to start now, you'd be hard pressed to get something done by the end of the decade. There just aren't the turbines available. And I think one of the things that people don't really appreciate about their electricity is that supply always needs to equal demand, and batteries have definitely come down in price. But the grid does need to be the grid from Maine to the Rockies to Florida always needs to operate in perfect unison. And so it's sort of an amazing achievement that happens every day that most people don't really realize happens right beneath their feet or in the wires coming down. The point is they can get new nuclear or the uprates of them or gas turbines, renewables, solar, wind, et cetera. We need them all.
Yeah.
And actually, I would also say, too, is that, one of the things that we're going to need to do, like it or not, is we're going to have to extend the life of our coal plants as well.
Yeah. Hopefully they can find a cleaner way to run the coal plants. But yeah, definitely with the current infrastructure that we have, is probably still needed. And to your point, it's an all of the above type of thing to generate the level of energy that we're going to be demanding over the next decade or two. So totally agree.
Exactly.
The environmental side of me says let's do all solar, wind, and water and battery. But the realist in me understands that coal power, gas power is still going to be there for quite a while until these other technologies can catch up, as well as cover the load that is needed. So I totally get it. Okay, so digging into the fund a little bit more, just for those who like the technicals, you guys started in February 2004. Mm-hmm. You do a monthly distribution of 19 cents per share.
Yep.
The distribution rate is right around 7% right now.
Yeah.
And last year, it looks like about 97 or 98% of the distribution was long-term capital gains, which is better for tax purposes. But there are some short-term gains that you might have to deal with. So it's not too bad of a situation to put in a taxable brokerage account. But as in a retirement account, you would have either deferred or no taxes on the distributions. You had mentioned earlier that you have a history of increasing it, and I know it's been a few years since it's been increased. Is that something that you guys are actively looking to increase, or is it data dependent, I guess?
Well, it's, I'm glad you put it that way. It's not just data dependent. We haven't raised the distribution in a while, and actually, to take a step back, we don't raise the distribution. Our board of directors actually raises it, and they do it at our recommendation. One of the things that you've observed is that the capital gains have been coming up, and the dividends have been coming down. That's actually been a conscious decision for us, and it kind of speaks to, we like buying things with a teeny bit more growth, and we like living with a little less leverage. We definitely don't buy the highest yielders in the space, and so that's sort of what's, everything that we try to do pretty deliberately. And similarly, look, the board of directors meets 4 times a year. Before anybody tries to get too cute about when we're going to raise the distribution again, I would just say that we're excited to do it too. But we want to kind of company that we would invest in, and we have a lot of investment around the firm and UTG. But what we want is to send a signal to the marketplace that not only are we capable of paying a higher distribution, but we're really comfortable with it, and we're making an editorial about what the future looks like to us. If you go back to the last time we raised the distribution, that was coming out of COVID. Interest rates were very low. We felt pretty good about the future, but then inflation hit, and we've had to absorb a higher level of interest expense. But we've done that, and we're feeling pretty good about having kind of made it through that. So things are getting to be a little bit more stable for us. So stay tuned.
Yeah. That makes sense. And the worst thing you would want, as well as us as unit holders, is for you guys to raise the dividend and go up a little too much and not be able to sustain that, and then having to cut it back in the future. So I'd much rather have a stable, lower dividend than one that gets raised but then gets cut a few years later. So I totally understand.
And it's not even that. We really, we really don't want to be in a place where we're sending people back their money and calling it a yield, because that's not really a real yield. I can certainly see how maybe things conspired to be a really tough situation for us, and we would consider it. But as part of planning, the sort of steady stair steps of increase that we've had over time, that's one of the considerations.
Yeah, that certainly makes sense. All right. So if you had to give an elevator speech to the benefits of investing in your fund and utilities in general, what would you tell investors the benefits of your fund or your industry would be for them?
I would say, look, we have the opportunity for a good income, modest earnings growth, and income risk that's well below the broader stock market.
Yeah. And then the history of your performance has been, fantastic. So, the history and you can kind of back up that policy where, you get stable returns over time and a consistent growth, as well as you get a really good income. I mean, 7% monthly distribution is very solid at this time and other times in the history of the market since you guys have been around. So that's really good. So obviously we talked about a lot today. You gave us some insight on the industry. What's the best way for people to find your fund and more information?
Sure. Well, let me just begin by saying we love engaging with our fellow shareholders. We love hearing what people have to say. We obviously have a website, and it's utilityIncomeFund.com. Please, by all means, feel free to call or write our IR department. They'd love to hear from you. We've got 2 very capable professionals who are actually alumni of our investment team, and they're very dialed into to really everything that we do. You won't have to dial 1 for more options. You'll actually get one of 2 very, very capable people. You can go to our website. You can sign up for our email list, and we promise not to spam you. And we'll try our level best to send you some stuff that's interesting. And Even still, I'm sure, Jeremy, you'd love people to leave comments. We would love you to leave comments too, because we'll take a look and see what you have to say. But we're a small firm. We're a closely knit family. We've all been doing this together for a very long time, and we're very proud of what we do. And we're going to look forward to a continued prosperous future.
Awesome. Well, thank you so much. Yeah. So for everyone that has questions for John or any other questions, definitely put it in the comment section below. We'll make sure that John and his team receive those questions, and we can either follow up via a reply, or we can do a video in the future where we talk through it if it's more in depth. All right, John, really appreciate your time. Love your fund. Thank you for going over the details for it. For everyone else, if you want more information, definitely go to utilityincomefund.com. And then with that, we'll go and end. Thank you very much, John.
All right. Well, thank you, Jeremy. Take it easy.
Appreciate it. All right, bye.
Yep. So long.